We don't experience losses and falls in the same way. You do need to pay attention to the possibility that things are going to fall, and that's where drip feeding can work, even if the maths tells you it's not the most likely thing to work out. Hello everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by Fidelity's Jemma Slingo to talk about the best way to deploy your money into investments, all in one go as a lump sum or drip fed in stages over time. The difference between those approaches can be very significant, and we're going to explain why in our conversation today. Before that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, and leave a comment if you want to do that. And once you've subscribed, remember to hit that bell icon at the top of the page to turn on all notifications and make sure that you get new content as soon as it is released. That all said, Jemma, welcome along. How are you?
I'm very well.
Now, this question of whether to drip feed your money into investments or just to stick it all in one go, it can be very relevant to new investors, I find, because it's often the receipt of a large lump sum that is the trigger for people to start investing in the first place. And so the first thing they're confronted with, or one of the first things, is exactly this question. So it really matters, doesn't it, how you approach it?
Definitely. So you might have an inheritance, you might have got a bonus at work, you might have just accumulated like a big pot of cash and want to put it to work. But I know from personal experience, you can often spend so long fretting about it and wondering what to do that you end up doing absolutely nothing. So
Yes.
I'm hoping today we can tackle some of the inertia and sort of set out the two different routes that people can take and why someone might prefer one over the other.
Yes, and we're going to look at this question first from a mathematical point of view, because there are sort of mathematical elements to this. But we're going to also look at the less tangible aspects, which are just as important, perhaps even more important. But first, Jemma, when does it make sense to invest your money as a lump sum?
So let's imagine a world where stock markets are steadily rising. So in this situation, it's better to invest your money as a lump at the start than drip feeding it into the market. And that's because if you invest it as a lump at the start, you're basically getting in at a point where markets are cheap relative to the future.
Yes.
Whereas if you're drip feeding it into the market, you encounter constantly rising prices, which means you're basically getting sort of less bang for your buck, I guess, as time goes on.
Yes, so having it all in at the start means there's more money exposed to that market for longer. And when markets rise, that's a good thing. We've got an example that we've worked through to help show that. It's a bit numerical. I'm going to run through it nice and slowly. So if you don't follow all of it, hopefully you'll get the logic of what we're saying. So imagine we've got two people and they both have £12,000 to invest. One does it all in one go and one invests £1,000 every month for a year. The shares start at £50 a share at the start of the period. So the person investing in one go gets 240 right at the outset. The shares then steadily rise by £5 a month until they reach £105 at the end of the year. Our drip feeder will have been buying £1,000 of shares each month through that period, but because the price keeps going up, the number they can buy each month falls. By the end of the period, the drip feeder will have bought 163 shares. So 240 shares for the lump sum investment, but only 163 shares in that drip fed scenario. Now, look, Jemma, the numbers are specific to the scenario we've laid out. They don't actually matter too much. Hopefully, the logic of all that is clear. If prices rise, it's best to have more of your money invested for longer.
Exactly, and that's a hypothetical scenario. Obviously, markets do not rise that smoothly over time, but we did apply it to some real life situations.
Yeah.
So, for example, we looked at the period between 2009 and 2019, which was a really good period for the stock market. Coming out of the financial crisis, which was obviously very bad, but then interest rates were low, big tech was getting going, the pandemic hadn't happened yet. So it was a really good stretch. And we ran the numbers for that situation and we saw, you would have made a lot more money if you had stuck a load of savings in at the start of 2009 compared to if you had staggered in your payments over that period. So you can map it onto real life situations as well.
Yes, indeed. And if it pays to invest in a lump sum in a rising market like that, the opposite must be true in a falling market, right?
Exactly, you just reverse the logic. So if markets are steadily falling, you think, well, if you invest right at the start, you're paying a particularly high price for these investments. But if you drip feed your money in, you encounter steadily falling prices. So you're able to buy more and more units as time goes on for the money that you've got.
Okay, now when you wrote about this recently, Gemma, you highlighted some numbers to show how likely it is, or it was at least, that investing as a lump sum would work and how likely drip feeding would work best. What did those numbers show?
Yeah, so if we take a step back for a minute, what we've been looking at so far is relatively simple arithmetic where everything is very nice and neat.
Yeah.
But in real life, you have two problems. The first is that markets don't tend to move really, really smoothly, like over short periods of
Not
time.
at all, no.
They tend to lurch up and down, and that makes the maths far messier. And the second problem you have is nobody knows what the future is going to be. So you can't say with any degree of confidence, oh yes, markets are definitely going to go up in that period. Mm-hmm. So if we go back to that example I mentioned between 2009 and 2019, it's really easy today sitting in a studio to be like, oh, well, if everyone had invested up front, they would have made loads more money.
Yeah.
But if you had just come out of the financial crisis, very shaken, presumably, having potentially lost a lot of money, the idea of chucking a load of your savings in the market up front could be quite horrifying.
Yeah.
So you're always going to be in this situation where you don't have perfect knowledge. So where do you go from there? It's basically that you can't fully rely on the maths. It's sometimes helpful to look back at history and think, okay, what can we learn from past experiences? And thankfully, loads of analysts have done research into this. And there's a particularly good study from 2012, which looked back through decades and decades worth of data and basically looked at what would have happened if you had $1 million and you invested it all up front and left it for a decade, or if you'd taken that $1 million and staggered it into the market over a year.
In that way that we described.
In the way we described, and then left it for the same period of time. And they found that in 2/3 of the cases, it was better to be a lump sum investor. You would have ended up with more money than if you'd drip fed it into the market.
Which is kind of another way of saying markets mostly rise, or spend 2/3 of the time rising and 1/3 of the time falling. And that kind of correlates with, well, that's the reason everyone invests in the first place, isn't it? Because markets do mostly rise. So from that point of view, it's logical to say it's mostly going to work out for you to put it in as a lump sum. But the problem is there are still significant periods of time when that won't work for you. And it's interesting, as investors, our experience matters, doesn't it? And we don't experience losses and falls in the same way. So you do need to pay attention to the possibility that things are going to fall. And that's where drip feeding can work, even if the maths tells you it's not the most likely thing to work out.
Definitely. I mean, I took away two things from that report. The first was, okay, drip feeding is less good a third of the time. A third of the time is still quite a lot. Like,
Yes,
you know,
quite
it's
a lot.
not a tiny amount. It is actually worth flagging that this report basically looked at loads of different time periods. So the example I'm talking about is you drip fed the money in over the course of a year. Mm-hmm. But they found actually the more slowly you drip fed the money in, so say you took 5 years to do that, the less and less attractive drip feeding became, the higher the probability that lump sum investing would outperform. So the timings you're looking at are important. But it also raised a really important point about worst case scenarios. So
Yes.
basically it concluded that, okay, some people might like averages and looking at what are my chances of outperforming, but a lot more people will probably be worried about what's the worst thing that could happen.
Totally.
Like if I put in a 50 grand inheritance into the stock market and the next day it went through the floor, how would you react to that? And it presumably wouldn't be very well.
Yeah.
So that's something you have to think about. And because drip feeding is better when the market is in a downturn, it can be a way of minimizing that downside risk in the short term. So if you're someone who is very, very fearful of falls and wants to minimize the worst case scenario, drip feeding can be a really sensible approach.
Yeah, I can totally relate to that. I think I actually heard, I've spoken to many professional investors over the years who say that actually, even for them, making these kind of phased investments is it just makes the whole thing easier to do. If you make an investment and the price goes up, then you feel great. You're a genius. You can make more of that. That's really good. Easy to do psychologically. If you make the investment and it falls, you can say, well, okay, but I'm going to get more for my money next time round. So it just makes the ride easier. It shouldn't be like that, but the truth is we're not perfect kind of robotic sort of logic machines, are we? It matters how we experience the returns. And that's why drip feeding, even though mathematically, as I think we've shown, is not likely to be the most advantageous way of investing, it's still really, really sensible for most people, I would say.
I'd say so. And, temperament plays a big part in investing. How you feel about your money. If you're lying in bed at night fretting about what your money is doing, that's an important thing to factor in. We're not machines, as you say, who can just plug in some calculations and think, oh, yes, this is the optimum result. Ultimately, it's your money, it's part of your life, and you should view it as such. You have to be comfortable with what you're doing.
Great. Well, Jemma, I think that is all the time we have for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. Hit that bell icon to get notified as soon as new content is released. Give us a like, share the episodes. It really will help others find what we're doing here. That all said, Jemma, thanks for joining me.
Thank you.